Hi, Megan. How's it going today? Thank you so much for rejoining after our after the meeting crashed. Definitely weird. Seems today is just one of those technical issue days. But I hope you're having a great day. Today is just one of those technical issue days. But I hope you're having a great day. Today is just one of those technical issue days. Yeah, at any rate, I hope you're excited to get some good tax tips. Feel free to unmute for the time being or to just put in chats how you're doing, if you're excited or anything like that. Because we've got a lot of great tax information to share with you today. I'm Danny. You've chatted with me over email, and I'm one of Christine's assistants. And I'm honored to be introducing Allison, who helped build today's presentation, and who you may have contacted to get into today's class with, and obviously to get back in earlier, along with Christine Walters, who will be showing you how you can save money on your tax return. Just so you know, Allison and I will be in chat, so be sure to keep your chat window open, as there will be tutorials on how to interact with the presentation, as well as how to set up your Zoom window for optimal viewing of today's content. We do ask that you remain muted for the content segments, and that if you have any questions, there will be dedicated question breaks, where you can either raise your hand via the reactions button in Zoom, or by typing your questions in chat with the send setting set to everyone. And we will address them in the order that we see them. Of course, with you just being in the meeting, pop it in, and we'll probably be able to answer a little more on the fly, depending on if anyone else comes in. Lastly, you may have your camera on or off, as you would prefer, but we always appreciate seeing your smiling face. Okay, so without further ado, here is Christine Walters.
Hi, Danny. Hi, Christine. Sorry, I just have I hopped on because I thought today would be a good day, but my little one is sick, so took the camera off and I'm on mute, and I also have to leave at 12:30. So I don't know if that still works for you guys, or.
Yeah, absolutely. And it's going live on Facebook as we speak. So you can always go back there to my profile or whatnot and see it there. I think Allison sends out a link to the recording afterwards as well. So as long as you can stay, we're happy to have you.
Okay, thank you.
All right. All right. So let's see if we can make the clicker work. There we go. So hi, everyone. I am Christine Walters from All Inclusive Accountants. And today I'm here to help you stop leaving tax money on the table. So I could sit here and tell you all about my education and experience, like where I went to school for accounting, Canada or College and State, what companies I have worked for in the past, like ConocoPhillips and Schlumberger, and some of the projects that I handled on those jobs, like setting up a UK division of a touring production company. But what I really want to share with you is a personal example from one of my clients that really impacted me and them, and how it enhanced the way that I approach my life's passion. So my client, Emma, is an acupuncturist and had been running her own small business for several years before we connected. Come on, clicker. Challenges galore. By some strange combination of events, Emma realized that, one, she was drowning in her bookkeeping, not sure of exactly what she should be keeping track of or how to keep track of it. Two, Emma didn't understand why the bank wouldn't consider her and her partner for a mortgage when they easily afforded more than $2,000 per month in rent and utilities. Three, every time she asked a colleague or another accountant about her business structure options, she was given contradictory advice. Some people telling her that it was the best decision they ever made to incorporate, and others saying it was the worst decision of their business life. And then the previous accountants that Emma tried working with either told her that she didn't make enough money to justify being incorporated, without asking any deep clarifying questions about her situation to be able to understand, truly understand if incorporation could be an option for her, or the flip side, having accountants trying to convince her that incorporation was the right option for her, but without really explaining why they were giving her that advice. And then four, the straw that broke the camel's back, as it were, was the CRA's constant review letters year after year. Emma was so sick and tired of those brown envelopes in the mailbox and the hours of time it took away from her family and business in dealing with the replies to CRA. Emma felt so frustrated, and Emma decided she finally had enough and sought out a new tax professional, which happened to be me. So at my first meeting with Emma and her partner Charles, I was instantly heartbroken for them. I could tell within minutes of looking over their last 3 years of tax returns that Emma and Charles had lost out on well over $15,000 in tax refunds with what I call small everyday, oh, I didn't know I could or should do that, or the flip side that I couldn't or shouldn't do that kind of mistakes. So they had missed claiming some of their childcare expenses. They forgot that Charles had a disability tax credit available to him. In one of the years, Emma had deducted an RRSP contribution when she wasn't even in a taxable position, forever losing the tax savings that an RRSP is supposed to provide you. They didn't take advantage of combining their medical and donation expenses on one tax return, which would have given them a much larger tax refund. So I actually had a current client, email this exact scenario last night. She had a $500, or he had a $500 donation, and she had a $200 donation. And she was asking why they were all on one return. So if we would have separated those onto his and hers returns, their tax refund would have actually dropped by $55. So it's actually a really significant amount with the donations. That's why we as accountants always try to combine them on one tax return. So anyway, sorry for that little ad lib there. So $15,000 in cold hard cash, that can make it or break it for anyone, right? Especially a small business. So what would you do if you had an extra $15,000? You can go ahead and let me know in the chat. And I see also Allison has launched the welcome poll. So just a little poll, tell us where you're from, how long you've been in business, that sort of thing. So we've got a little bit of demographics. So what happened next for Emma is first, she took my advice that based on their circumstances and all the questions that I asked them, that it actually did make sense for Emma to incorporate her business. Next, we set up Emma's bookkeeping in QuickBooks Online to ensure that we were capturing all the possible expenses related to her business. And I made Emma and Charles promise that they would stop using cash to pay for things so that we could fully understand where the money was going and where there could be room for improvement in their budget. And finally, after working with me for that first year to cover off all the bases, Emma and Charles implemented some of my suggested tax saving strategies on the personal side of their taxes that saved them even more money. So within 5 years, it's been about 7 years now that I've been working with them, Emma and Charles were able to pay off most of their credit card debt, start a regular savings plan for their retirement, start saving for their children's education, and they were finally able to get a mortgage to purchase a piece of land that they built their dream home on. So as I continue to work with them, I'm excited for what will come next. So over the years, I've come to be an affinity partner with the Massage Therapy Association of Alberta, and I now create courses regarding all things business, accounting, and taxes for wellness professionals, such as RMTs, acupuncturists, and chiropractors, to name a few. So I love educating people on how to save money on their taxes, and that's why I'm so glad to have you here in my masterclass today. So because each and every person or family situation is unique, I provide customized advice taking into account the facts that are unique to each client's situation. And I'm honored that my countless questions helped Emma and Charles begin realizing some of their lifelong dreams. And now, just by being here, you are all taking the very first step, or one of the first steps, to paying less in taxes and keeping even more money in your pocket. So who's ready to get started with me? Go ahead and give me a wave, or put a yes in the chat, or use the raise hand function in, I think it's the reactions in Zoom. And I'm just going to take a drink of water here. So this class is for you if, one, you are unaware or concerned about how much you are overpaying CRA in taxes, or just don't understand why you pay so much in taxes. This class is for you if, two, you've received conflicting advice in the past, or don't know or don't understand what your options are for setting up your business. And three, this is for you if you're living paycheck to paycheck and sick and tired of not being able to get ahead financially. So today, I will, one, demystify how tax works for small businesses, so that you can have a better understanding of the options that might be right for you in your situation. I'm going to, two, share some overlooked tax saving strategies so that you can get even more tax savings for every dollar that you earn. And three, I will show you with a real life example why relying on CPP, Canada Pension Plan, may not be your best retirement strategy and what you can do instead. So before we get into it, to ensure that you get the most benefit from today's session, engage yourself in this session. We want to be able to communicate with you as effectively as possible. So please disconnect your mobile devices if you can, and keep your video on. I do like to see your faces. I'm looking forward to all of us having a very productive and knowledge-building session. So please stay muted in the session until the Q&A, or we call an action to unmute yourself during the session. So now the legal disclaimer. So this presentation is intended solely for the attendees of this masterclass presented by me, Christine Walters. It is for general use and may not be reproduced, used, circulated, or published in whole or in part without the written consent of my company, All Inclusive Accountants. All Inclusive Accountants will not assume any responsibility or liability for any costs, damages, loss, liabilities, or expenses by anyone as a result of the circulation, publication, reproduction, use of, or reliance upon the information presented during this masterclass. So the non-legalese version of that is basically don't take what I'm about to tell you as gospel for your situation. There's lots of nuances and particulars that apply in each and every individual circumstance. So yeah, like I said, don't take it as gospel for your situation because it may not be. And then I promise by the end of our time together today, it's daytime now, sorry, you and your small business will be ready to implement some, if not all, of these tax savings tips. So I know that this subject is my passion, and I could go on and on, delve into it for hours and hours and tell you all kinds of stories. And for those of you high achievers in the class, I'll have you covered and have an option for you at the end of the class. So small business owners balance many things: bookkeeping, advertising, marketing, clinic or business administrative tasks, filing GST and tax returns, keeping tabs on the business's profitability and cash flow, and of course, thinking about their retirement and other life goals such as buying a house or sending kids to university. Many small business owners think or have been told that they aren't making enough money to become incorporated, which oftentimes isn't true. So I've had clients who have incorporated when their revenue was as low as $25,000. And I often come across new clients that are already incorporated and they don't actually even have any revenue yet. Or those small business owners don't totally understand what business structure options they could be utilizing to save even more money on their taxes. So first up, we're going to meet Joe, Mark, and Tony. So they're all friends who work as massage therapists. The difference between them is how their employment or business structure is set up. They love to have fun and hang out together, especially partaking in long weekend fishing trips. All three of them earn about the same amount of money, approximately $60,000 a year, gross before any deductions. So first up, Joe. So Joe just doesn't understand how his friends Mark and Tony can afford to spend so much more money than him on fishing gear. It seems to Joe like Mark and Tony are always sporting the latest and greatest gear, and it makes Joe feel like his friends have a better quality of life than he does. Joe often feels like he's spinning his wheels and can barely get ahead on his day-to-day bills, never mind investing in updated fishing gear. Joe is often really depressed that he has to say no to the longer fishing trips and wonders what he can do to change things up to be able to spend more money like Mark and Tony. Don't we all wish we could have more money to spend on fun experiences? So go ahead, feel free to let me know in the chat if you had some extra money, what you would do with that. So Joe is an employee for LifeMark and earns about $60,000 gross per year. So Joe pays about $14,450 in taxes, including his CPP and EI premiums. So his average tax rate is about 24%, making his take-home pay for the year about $45,550. So now let's meet Mark. So Mark has a small massage therapy business, which includes providing mobile services, as well as working from his home-based practice. Mark also grosses about $60,000 a year, but is a sole proprietor. Because Mark's business is set up as a sole prop, he only pays taxes on about $40,000 of income, not $60,000 worth of income like Joe. So this is because Mark is permitted to write off some of his household and vehicle expenses in addition to his MTAA fees, his cell phone, his internet, his training courses, and of course, all of his supplies. So this sole proprietor business structure allows Mark to have a lower average tax rate than Joe of about only 15%. So Mark only pays about $9,045 in taxes, including his Canada Pension Plan premiums. And his after-tax take-home earnings is higher than Joe by about $5,000 at just under $51,000. So this extra $5,000 gives Mark more freedom to spend more of his hard-earned money on his fishing hobby. And then finally, let's meet Tony. So Tony's massage therapy business is incorporated. And like Mark, he does mobile services as well as working from his home-based practice. So Tony, just like Mark and Joe, earns a gross income of about $60,000. But by being incorporated, like Mark, Tony gets to write off a bunch of his expenses related to his business, such as part of his home, his car, his MTA fees, his supplies, and items related to advertising and marketing, etc. So Tony's incorporated business structure allows him to take advantage of an even lower combined tax rate of about 10.5%. So Tony pays about $6,300 in total between his corporate and his personal taxes. So Tony has an after-cash tax flow of about $53,700, so about $3,000 more than Mark, and about $8,000 more than Joe. So no wonder why Tony's always got the best gear on the lake, right? So which boat would you like to sail in? The canoe, the sailboat, or the yacht? So with the sole proprietorship and the incorporation structures, Mark and Tony are allowed to write off a lot more of their everyday bills. Writing off those bills allows them to pay less in taxes and therefore have a lot more disposable income to play with. Just this small difference in business structure is one component that determines someone's overall taxes and therefore how much extra cash flow you have to spend on your favorite hobbies or your favorite vacations. So learning from Joe, Mark, and Tony, I've highlighted one way that small businesses can save even more money on their taxes. So depending on your personal situation, sometimes it makes sense to change your business structure. Who's thinking they might need to or want to change their business structure to keep even more of their money in their pocket right now? So while you take another drink, you can feel free and let me know in the chat. Pop a note in the chat about what you would do with some extra money, or if you're thinking about changing, that you might need to change your business structure. All right, so moving along. So have you ever thought that professional tax help costs too much money? Maybe some of you have thought in the past, it's so simple that I don't need any help. Let me know in the chat if that has ever been you in the past or a family member. Oftentimes it's the reluctant partner or other family member that says those things. But there might be some tax saving strategies that you could be missing out on that would help you save even more money from the very first dollar that you earned. So I'm going to share some stories of clients who previously thought exactly this. So meet Eleni. She's one of my longtime clients. She was diagnosed with terminal cancer back in 2016. 6 years later, it hasn't been easy. Her kids have had to take time away from work to support her, and Eleni has been in and out of supportive living arrangements through this whole time. Back in 2016, Eleni was only given about a year to live, but was fortunate to stay with her family until just a few weeks ago. She just recently passed away, and her son Rob, who had handled the taxes for his mom in recent years, reached out to me late last year about her 2020 taxes. He thought he would save himself a little bit of money and prepare Eleni's taxes himself. But after the fact, he received multiple brown envelopes from the CRA denying all of Eleni's medical-related claims. And then the last brown envelope that he got had a bill in it for just over $18,000 in taxes. With Eleni now in hospice, Rob was distraught with worry about why these legitimate claims were being denied and where they were going to find $18,000 to pay the taxes if they couldn't get the claims accepted by CRA. So no one ever likes receiving letters from the government saying that we owe money, right? Do we? I know I don't. In fact, I don't even open them. I just put them on a pile, and usually in about August when I've got nothing else to do, then I'll open them and they mostly get shredded. But anyway, that's just me. So Rob needed guidance on how to handle the situation and how to report Eleni's medical and assisted living expenses for her final stages of life on her taxes. Rob was afraid that they had lost out on the ability to make any claim in 2020 for these expenses because he didn't reply to CRA's initial notices within the stated timeframe. I reassured him that once we got all the appropriate supporting documentation, we could resubmit and make most, if not all, of that $18,000 bill go away. In early 2020, they had renovated part of their house to make it more accessible, or part of Eleni's house to make it more accessible for her to spend her final months comfortable in her home. They didn't know at the time that they undertook the renovation that this type of expense can have a special categorization on the tax return. They had included all $20,000 of these expenses in the medical claim when they should have claimed $10,000 under the home accessibility tax credit. And there was about $9,500 that was specifically related to installing a wheel-in accessible bathtub. So I asked Rob if they thought they would be able to get any one of Eleni's doctors to sign a prescription for the bathtub installation. Fast forward a couple of weeks, Rob lets me know that yes, he could get the prescription, and now we will be able to claim that $9,500 specifically related to the bathtub renovation as a straight up medical expense. Without that doctor's note, we would have never been successful in getting that wheel-in bathtub renovation accepted as a medical expense. So many people don't know that a lot of everyday things, especially if needed for an ongoing medical reason, can be claimed as a medical expense if your doctor gives you a note or a prescription. So things like blood pressure monitors, pregnancy support belts, slings, immobilization splints, all of those things kind of fall into that category. The other large component of Eleni's expenses was the cost of the care in the assisted living facility. There are special rules regarding the amounts that can be claimed each year for attendant care if you're also eligible for the disability tax credit. So Rob had completed Eleni's tax return with the limited assistance provided by the program and didn't realize that he had a choice between claiming the entire $29,000 of attendant care expenses or claiming $10,000 of attendant care expenses and the disability tax credit. So it's the person who's preparing the tax return who has to figure out what the best combination of claims is. And regular folks often don't understand all the different options. And so they just kind of by default go with what the program, advises or directs them to. So this is exactly what happened to Rob. He just did what the program said. However, in hindsight, when I analyzed all the medical costs from 2020, 2021, and what they thought they were going to pay in early 2022 before she passed, I advised Rob that we could legitimately kind of pick and choose how much of each type of expense to claim in 2020 versus 2021 versus 2022 to get the best overall combined bottom line for those 3 years while leaving the least amount of unclaimed medical expenses and other tax credits on the table. So for those of you that don't know, in the year of death, the dollar limit for attendant care expenses is doubled, and the time frame for claiming medical expenses it also doubles or extends from 12 months to 24 months. So when I looked over all the numbers, I determined that for 2020, it actually made the most sense to forego that disability tax credit in favor of claiming all $29,000 of the attendant care expenses. And then we claimed $10,000 of the renovation under the home accessibility tax credit. And now with her doctor's prescription, we were able to claim the other $9,500 related to the renos, for the bathroom renos as a straight up medical expense. So the bathtub renovation got claimed or is getting claimed in addition to her out-of-pocket prescriptions, her dental work, and her paramedical treatments, all the regular medical stuff that goes into a tax return. Then for 2021, so the tax return that we're working right now, because the attendant care expenses are significantly less at about $15,000, we're only going to claim the maximum of $10,000 and the disability tax credit and carry that leftover $5,000 onto the 2022 taxes, where now, because that's her year of death, she will be able to claim $20,000 of attendant care expenses without losing her disability tax credit. So put yourself in Rob's shoes. Was it worth all the additional hassle for Rob to prepare the taxes on his own? He ended up causing himself great stress. He had trouble with CRA. He potentially had to repay up to $18,000. And he had the possibility of foregoing future tax savings or additional tax savings in the following years by not being well versed in the nitty-gritty details and what you can kind of, like I said, pick and choose and, make the best bottom line. So before I tell you my next story about GST and I take a drink of water, feel free to let me know in the chat what you think of Rob's story. Okay, so with GST, the most frequently asked questions we as tax professionals are one, when should I register? And two, when do I have to register? So every small business has to register when their revenue surpasses or crosses $30,000 in any 4 consecutive rolling calendar quarters. So that's the CRA legal speak. To simplify this, what it basically means that in any 12 rolling calendar months, when you reach $30,000, then you need to register. So if you look at the chart here on the screen, you can see that throughout the calendar year, this person earned a total of $26,400. So from January to December, the blue column, that adds up to $26,400. But when you drop the prior year, January and February, and add the current year, January and February, you can see that the running total is now over $30,000. It's at $31,200. So that's the point where they're required to register for GST. I always like to suggest that you register for GST before you're required to for a couple of reasons. The first one is because it often ends up being cash flow positive, meaning that you actually end up with more cash in your pocket when everything is said and done. So if you check out this chart on the slide, here's an actual example of the positive cash flow for someone who is not required to register for GST that they would experience. I'm just going to fold this thing down so I can see it better. So in the first column, the not registered column, there's $29,000 worth of revenue, right? No GST collected. Nice and easy. They spent $5,000 on expenses with $250 of GST. So taxable income, this person's going to pay tax on $23,750. So income tax is owing just over $3,584. So cash flow for them is $20,165. Sorry, I just got lost on my notes. And then the second column, the column on the right. So if this person had been GST registered at $29,000 where they're not required to be, they would have collected $1,450 worth of GST. They still paid $5,000 in expenses, but now the $250 worth of GST paid on those expenses comes out of the tax return and goes onto the GST return. So the taxable income is now $24,000. So yes, they pay a little bit more in income taxes. They're going to pay $36.67. But when you do all the math, their actual cash flow is $20,582. So it's $417 more in their pocket by being GST registered than by not being GST registered when you don't have to be. And then the second reason is I find what often happens is that, especially with wellness professionals, that you end up getting close to reaching the $30,000, and then you get busy with work and life and whatever, and you blow right past that $30,000 target, only to realize in March of the next year, so right now, when you're getting your taxes ready, that you should have registered months ago. And now you have to jump through a bunch of hoops to make everything right legally, or you end up having to ultimately pay the GST that should have been collected that you didn't collect out of your own pocket. So the next question that I always ask is about the GST reporting or filing frequency. So for those of you that don't know, you can file your GST return monthly, quarterly, or annually. So as a sole prop in most incorporated businesses, people choose to file annually. But occasionally I come across somebody who has chosen to file quarterly because they think they're going to be rock stars and get everything done and have everything balanced on time and submit it. But in reality, my experience is that only like 5% of people can actually make that happen. People have really good intentions, but they hate taxes. It's not what they do, right? They're yoga instructors, they're massage therapists. The last thing they really want to do is GST returns 4 times a year. So anyway, with a quarterly filing, you only have 30 days after the end of the quarter to file before you get a late penalty. With an annual return, you have until June 15th before you get a penalty. So why would you stress yourself out 4 times a year with only 30 days to get everything done when you could do it once a year and have like 165 days or so before you end up with a late penalty? So oftentimes the question that comes, or the comment that comes up with this is, well, I don't want to keep the GST money because I don't want to spend it, right? If I have it, then I might spend it. So you can make payments to CRA every day, week, month, year, quarter, insert frequency here. So you can pay CRA the GST as often as you would like, but just do the work of filing the return once. So the filing frequency of your GST return doesn't prevent you from making payments at any point during the year. It would be like, for those of you who make installment payments on your tax returns or on your taxes, your personal taxes, because you're self-employed, it's the same concept here. You'd just be making an installment and then we apply it when we do the tax return and you pay any difference at the bottom line, or you get some money back if you happen to have overpaid. So the reporting threshold that requires someone to go from annually to a quarterly filing frequency is $1.5 million. So most small businesses, even if you're running a clinic or 2 clinics, are nowhere near that range of sales. And I hear it all the time. Dealing with the GST is super frustrating and super overwhelming. So I just, personally recommend having a tax professional help you deal with that in some way, shape, or form, whether it's just reviewing what you've done or having them do it all with your tax return so everything lines up and matches up. So anyway, I recently got a new client, Lindsay, who reached out because of a Facebook post that we did specifically related to GST. She was concerned because she was getting ready to do her taxes for last year. And when she added up all of her numbers, she was at like $45,000 in revenue. She had crossed that $30,000 mark sometime in September, so she was super concerned about what happens to people who forget to register for GST. So Lindsay had reached out to friends and coworkers or co-colleagues, and most of them had given her conflicting advice about what her options actually were to rectify the situation. So what most people don't realize is there's actually a process to rectify a situation like this so that you don't raise more red flags with CRA, and so that you're not ultimately responsible for remitting or paying GST that you didn't actually collect. So in Lindsay's case, the amount of GST owing isn't that much. It's about $750 that she would have been out of pocket. But I'm all about helping people keep money in their pocket, not in the government's pocket. So for Lindsay to not have to pay that $750 in GST out of her pocket, we needed to set her up for success by 1, immediately registering her for GST. 2, as part of that registration, we were able to backdate it 30 days to the beginning of January. 3, she then took her GST confirmation back to the clinic she was working at and requested that they pay her the GST from that point where she earned $30,000 in September. So because she has a GST number now, the clinic can legally pay her the GST. And for those of you that don't know, businesses, any business, is not allowed to pay a subcontractor or any vendor GST unless they've provided a GST number. So in recent months, it's come up quite frequently that there are a lot of clinics here in Alberta that are paying GST to contractors who don't yet have a GST number. This is a big no-no, not so much for you guys as the subcontractors or contractors, but for the business, the clinic. So if that business or clinic ends up getting audited for their GST and they don't have a record of a GST number for someone they paid GST to, they will be denied that deduction from their GST tax return and have to repay that to CRA. So the business or the clinic would be paying it twice. First, they paid it to you, the contractor, when they weren't supposed to, and now they're having to pay it to CRA because CRA is going to deny it because they weren't allowed to pay it to you because you didn't have a GST number. So once Lindsay has been back paid her GST and has all the documents supporting the collection of GST from that date in September, we do up a nice cover letter, spell the path for CRA about who did what, where, when, and what we're asking them to do. We attach that with the pay statements and the other supporting documents, and we send it off to the CRA tax center. And then we wait many, many, many days for a response. But anyway, so once we wait for a response, there's like a 98% chance that she's not going to have any problems with her request to have her GST backdated, because we did everything in the correct order. We got registered, we backdated it as far as we could. We went back to the clinics, we collected the GST, we've got proof that we collected the GST. Then we sent everything to CRA with our request, with all the supporting documents saying, you know what, I made a mistake, I blew past it. As soon as I realized it, I corrected it properly. And by doing all of that, CRA will most likely accept the backdating of her GST to September 17th. And then when we will file her GST return from September 17th to December 31st, when we file her sole proprietor tax return here, it'll probably be closer to the end of April, as we very impatiently wait for CRA to get back to us on the letter. But anyway, it's very, very easy to blow past that $30,000 threshold, especially because wellness, like I said, wellness therapists are very busy in the last part of the year because everybody's trying to use up their benefits. So like I said, GST can be cash flow positive. And for those people who are going to work out of their home or do mobile, it can also be advantageous to be GST registered early, because for those of us in business, there's a perception or a credibility component that you should be aware of. So if I go get a massage from somebody who gives me a receipt that doesn't have a GST number on it, and they're just charging me $100 for my hour massage, I know that they're making less than $30,000. Whereas if you're GST registered and I come get a massage and my receipt says $100, $105 for 1 hour massage, and you've got a GST number on it, I don't know if you're making $1,000, $10,000, $30,000, $50,000, $500,000 because you're GST registered. So for those of you that, you know, at some point might be considering a change in your status, going out on your own, moving away from a clinic, going into working out of your home or doing mobile or whatever that looks like, it can often be, in my opinion, it's advantageous to be GST registered. The second part of that is that when you're not GST registered and then all of a sudden you get GST registered, your clients see that as a 5% price increase here in Alberta. Just imagine in Ontario, that's a 13% HST increase, right? So your clients see that as a 5% price increase, but none of that money is actually really going into your pocket. Like a portion of it is, like I said earlier, it's cash flow positive, but it's not actually going into your pocket, right? So your clients see that you're raising the prices 5%, but you're not. All you're doing is just adding the GST. So it just becomes an easier sell business-wise to just be GST registered before. And then when you do increase your prices, it is actually going in your pocket. All right, so another medical story. This one's more specifically related to businesses. So Beth is another longtime client, and she recently came to me with concerns about her employee benefit plan. So at her aesthetic spa, she has about 7 employees and had historically provided them benefits through Blue Cross. Her Blue Cross premiums seem to be increasing dramatically every year, as they do. And she wanted to find a more cost-effective way to provide benefits to both her and her own family and her staff. So I bet some of you have been in the same place as Beth is, or Beth was, wondering how to get cost-effective benefits for you and your family, or you and your family and your employees, depending on what the situation is. So with my help, I taught Beth all about educated Beth all about the private health services plan that's available to her. So because Beth is a sole proprietor with at least 1 employee, with a private health services plan, every employee is allowed up to $1,500 as a direct reimbursement for any out-of-pocket medical expenses. So Beth changed her core benefits package with Blue Cross to cover prescriptions, basic dental, and basic medical, removing major dental and vision, which for those of you that don't know, are the 2 most expensive components of any benefits plan. And then she set up the private health services plan, allowing each of her employees $1,500 to cover any out-of-pocket medical expenses that they incurred. So by separating these expenses and adding that private health services plan for her 7 employees, her total costs are still about 30% lower than what they were before when she was just dealing with Blue Cross. So fast forward a couple of years to when Beth wants to incorporate, she will be able to offer her employees a benefit and compensations plan or package that caters to their individual needs. So if I want to spend the money on dental, I can. If Daddy wants to spend it on glasses, he can. If Allison wants to spend it on chiropractor for her kids, she can. We get to use it for whatever works for our situation and our family. So in some simpler terms, health and dental expenses covered or offered through a private health services plan are fully tax deductible to the business, and all the benefits that are received to the employee or the recipient from the private health services plan are also 100% tax-free to employees. So kind of the same thing as insurance, except for it's not insurance. It's more like a health spending account. So the main attractions for this type of plan are, one, from the employer side, controlling the cost. You know exactly how much you're going to pay. And then two, from the employee side, like I just said, each employee gets to choose what they want to spend that money on, what works best for their family. All right. So now I'm going to talk about Mike. This is a little bit of a COVID story. Well, mostly just because it happened in COVID, at the start of COVID. So Mike is the owner of a small construction business. And let me tell you how at the start of COVID, he thought his world was turning upside down, and not for a good reason. With all the sudden restrictions on businesses, Mike was super stressed because his construction business involved going into private homes to fix and replace windows and doors. So Mike's initial concern was that he didn't qualify for CERB because of the type of income he had reported on his prior tax returns. His family includes 2 disabled children, which brings on its own set of concerns as well. So he was so distraught, him and his wife were so distraught, as many people were in the world at that time, that he wouldn't be able to feed his family, pay the bills, keep them in their house, all of that, right? We were all freaking out, some of us more than others, but basically we all had some level of freak out, right? So Mike reached out to me and asked if there was anything that he could do to qualify for CERB. So I quickly asked him and his wife to sign CRA consent forms so that I could log in and take a look at their personal and business tax filings. So I won't bore you with all the details, but essentially, because his business is incorporated, I could see instantly that, yes, we did have some options for changing the type of income that they had reported. So we removed the $20,000 of other income from Mike's tax return and reported $12,000 of T4 employment income. That change made Mike eligible to apply for CERB. So for those of you that don't remember, one of the requirements, or the biggest requirement to be able to collect CERB, was that you had to prove $5,000 of T4 income or self-employment income. And with his $20,000 of other, he didn't meet that. So we filed a T4, made him meet that requirement. We also increased his wife's income from $0 to $8,500 with the T4 employment income, because she was the unpaid bookkeeper, administrative assistant of the company. So we gave her a salary for that year and also made her eligible for CERB. Plus, these changes had the added benefit of increasing their initial refund from like $666 for the climate action incentive to $2,322. So I'm nothing but very candid with everyone that I work with. So to give you the full picture, Mike did have to pay $510 for CPP, plus a small penalty for reporting in April instead of February, but he still netted like $1,200 in his pocket immediately. And then after helping them with CERB, I wanted to help this family even more. I learned through our conversations that a huge pain point for the family was that their mortgage was coming up for renewal again, and they had always struggled in the past with trying to get a better rate. Because they didn't fully understand how to pay themselves and take advantage of all the deductions and credits available to them, they never reported an income high enough to be able to shop their mortgage properly. They were stuck renewing their mortgage with an institution that just kept increasing the rates. So I showed them, by taking advantage of all the deductions and credits available to them, how we could increase their combined line 150 income. So for those of you that don't know, that's what the bank looks at when trying to, one of the things the bank looks at when trying to decide how much of a mortgage that you qualify for. So we increased their combined line 150 income from around $25,000 to just over $100,000, and they still ended up with a very low tax bill. Sorry, give me one sec. Okay. So this helped them amazingly. I think we need to change that word, Allison. I can't ever say it properly. They were now able to qualify for a 1.8% mortgage rate for their $475,000 home instead of the last renewal rate of 4.6%. This adjustment is going to save them just over $73,000 in mortgage interest over the next 5 years, and of course allow them to be mortgage free even sooner. So go ahead and throw a comment or an emoji or a thumbs up or something in the chat if you've ever struggled in the past with trying to buy a home and get the mortgage approved or renew your mortgage at a lower rate. Because I'm sure, well, actually, I think I jumped this morning. Or actually, it was last night. So we've got a comment in here that says, "Don't we all want to be Mike and be mortgage free even faster?" So, and my thought process is I'm going to die with the most mortgage debt that I can have, because I plan to use that low interest money to do other things. So I don't ever plan to not be mortgage free. But that's just my take on it. So a tax professional is probably not the first place many of you would think to look for assistance with getting or renewing your mortgage. But that's just one of the benefits working with a tax professional who takes the time to understand your situation can provide you. All right, so a QuickBooks story now. So my clients, Laura and Steve, had been using a desktop accounting software called Sage 50 for many, many years without any issues. And I used to use Sage 50 religiously myself. I loved it. But they recently mentioned that they were looking for ways to streamline their bookkeeping to make things more efficient. They wanted to be able to spend more time sourcing new jobs and new contracts and less time on the day-to-day bookkeeping, and of course, spending more time with their young family, right? So listening to their frustrations, I offered to set them up with a trial of QuickBooks Online. We connected their bank accounts during that initial setup call, and I coached Laura on how to do most things in QuickBooks. This was a great way for her to experience how quick and efficient and easy QuickBooks is to use for their business. So as I was setting her up, teaching her how to deal with invoicing and matching payments received in the bank to the invoices, Laura started telling me a story about a customer. They were having issues with payment over. Sorry, that doesn't sound right as it's coming out of my mouth. But anyway, the client, it's actually two clients, a brother and sister, as they lived in a duplex. Almost a year after the contract was signed and the work was finished, they initiated chargebacks through their credit card company. And Laura and Steve were shocked one morning when all of a sudden $14,000 disappeared from their bank account. So with most credit card companies, the agreements that you sign when you're opening your account state that they're allowed to take money back out of your bank account for chargebacks. So Laura and Steve, like I said, were shocked to find this out kind of the hard way. I think we all kind of are. We all sign, all the fine print and the 17 pages of stuff that you're supposed to read. We just sign our life away and it's never a problem until it is, right? So the credit card company requested paperwork from both sides to try and resolve the dispute. For a long time, they went back and forth. Basically, at the end of it, the credit card company decided to side with the customer, despite all the paperwork, the contract, Laura and Steve being able to file liens against them, like against the properties, and the lawyers getting involved in all of this. So anyway, sorry. So with the whole situation, it left them stranded with no possible way to take any new payments through their current merchant services, because as soon as they would ring a credit card through, the merchant services would hold that funds to recover this $14,000, right? All this back and forth. It went in, it went out, it came in. I lost count of how many times it went in and went out. But anyway, so they couldn't process any new credit cards through the current merchant services because they were going to hold the money. So during our call that evening, they had mentioned that they were going to meet with the new bank the next day to open an account and open new merchant services. So I mentioned to them that QuickBooks has merchant services built right into it, and that the rates are basically, comparable to Moneris and Chase and Square and all of that. And if they were interested, we could sign them right up and, see if it was going to work for them. So I'd also told them that whenever I'd done this in the past for a client or with a client, they were usually approved in like a day or two, right? 24 to 48 hours. So they were definitely interested, and we did the application right there over Zoom in QuickBooks. And the confirmation, of course, told us you'd be hearing something back in 5 to 7 days. So we carried on doing what we were doing, finishing the setup of QuickBooks and setting up the invoices. And about 40 minutes later, while we were setting up one of the last invoices, I noticed that it looked like the credit card services had actually been turned on. And sure enough, when we clicked into their settings, they had already been approved. So in like less than an hour, they were approved for QuickBooks Merchant Services, and now they didn't have to go to the bank and get that there and rent a new terminal and all of this stuff. It could all be done right inside QuickBooks. So I showed Laura how to set up and process credit cards right inside of QuickBooks. Laura was delighted and thrilled to be able to rectify this situation so very quickly without even having to leave the house, in a program that she's actually not even paying for yet because she's on a free trial. So as soon as they got the new bank account set up the next day, they could reprocess those 5 to 6 outstanding transactions and get the money flowing back into their business so they could pay for the windows and doors to do the rest of the installs and all of that. And then, of course, this just helped them be able to, keep going and keep providing their best services to their clients. So I was thrilled as well to be able to help Laura and Steve be able to see the light at the end of the tunnel, move on from some of their trying situations. I'm definitely well versed with trying situations right now, even to the fact that you saw this morning that we couldn't get me connected with a microphone or speakers or anything. So trying situations are abound. Anyway, so now there's Paul. So Paul is the longtime husband of a chiropractor client. The year that Paul and my client Anna got married, she kind of talked him into having me help prepare his tax return because they had just had a baby, and with the transfer of credits and additional child-related expenses, she thought that it made sense. So Anna was really nervous about all the expenses of having a child and just wanted to be able to maximize their refunds to help. So at first, Paul was very reluctant to meet with me, but soon realized he was better off having a dedicated accountant to ask questions to maximize every possible deduction available to him. So when we sat down and discussed his situation, I discovered that he had moved a significant distance from his job just north of Cochrane for his job. So he moved just north of Cochrane, from just north of Cochrane to New Brighton here in Calgary, southeast Calgary. So Paul didn't realize at the time when he did his taxes that he would be able to claim moving expenses and things like his legal fees and real estate commissions for his house, which those two components added up to just over $13,000. And all he had to do was get a simple letter from his employer saying that they requested that he move location. So moving from the location in Cochrane to the location in southeast Calgary. So Paul's refund went from $3,872 to $7,951. So he got like just over almost $4,100 back of money that he was leaving on the table with the government, and he didn't even know it. He didn't even know that he was allowed to claim that. So for those of you that don't know, if you move for anything related to work, school, or a job, as long as you move 40.1 kilometers, then you can claim your moving expenses, which can include real estate commissions, legal fees, and a whole host of other things. So anyway, what a huge help that was to them and the new baby. So is there anyone here who would be interested to see if if they are leaving or have left any money on the table in the past with the government? And then we're into our final story before we go and do a little recap. So my client Jackie sought me out after her mom Karen passed away after a long battle with stage 4 breast cancer. She wanted me to review the estate and the final tax returns. Going through the whole probate process, Jackie learned a lot about tax-related things that she never really previously thought about. The most surprising one for her was learning about her mom's contributions to CPP, Canada Pension Plan, over all the years of her self-employed life. Jackie had found a recent CPP contribution summary in her mom's files and wondered what the options were to retrieve the rest of what she thought was her mom's retirement money. I had to inform her that with CPP contributions, once you pass away, your family is only entitled to a death benefit, which at the maximum is $2,500. So Jackie reviewed all the information that she had and that she found, and she calculated that over her mom's lifetime, she had contributed just over $70,000 to CPP. So with literally just retiring recently and collecting CPP pension benefits for just over a year, Jackie realized that her mom, Karen, only received just over $10,000 in benefits. Upon further investigation and calculation, Jackie realized that to break even with CPP, her mom would have had to live and collect CPP benefits until she was about 76 years old. So Jackie is a small business owner as well, and through all of this investigation, she started to doubt her own plans for her retirement. She became very worried and started asking questions to hopefully safeguard her own money. At the time, Jackie wasn't married and didn't have any children, but definitely wanted a better option than what had happened with her mom's money. So while discussing all the options with me, she learned that while she was contributing to CPP each and every year when she completed her taxes, she would likely only ever get about 50% of the maximum monthly amount, receiving what is in today's dollars about $600. But she would have contributed about $270,000 to CPP over her lifetime, over her working lifetime, which for Jackie means that she would have to collect her CPP benefits until she was about 80 years old, 79 and change, to get out dollar for dollar what she's put in over her lifetime. So has anybody here ever reviewed their CPP retirement information that's available in your My Service Canada account? So usually when I ask this question, the people that are on the call shake their head saying no, they haven't. So it is something that I encourage you to go and do. Go take a look at those numbers, see what they look like. They are a little skewed, especially the younger you are. The younger you are, the better they look. The older you are, the more accurate they become. I actually have an idea. Danny, remind me later on. I have an idea about how I want to do that for the course. So anyway, Jackie wanted something better. So we discussed incorporating her small business. So even with starting a little bit later in life at 30 years old, if she incorporated and saved the same amount of money that she would have been contributing to CPP in a TFSA at 8%, she has the potential to have almost $1.7 million tax-free when she is 65. This math, of course, blew Jackie's mind and changed her previous thoughts about incorporation. Jackie is now in charge of her retirement and has the added benefit that if she happens to pass away before she turns 65 and starts collecting CPP, she will be able to pass along most, if not all, of that money tax-free to whomever she chooses. So let me break it down in a little simpler terms for you. So here are the numbers related to Jackie's situation. So Jackie has been earning about $32,000 from her self-employment after her expenses each year. So that's what she's paying tax on. So if we assume that she earned that same amount in all of her working years, adjusted for inflation, so a little bit less prior years, more in future years, she would have contributed, like I said, about $271,000 to Canada Pension Plan over her lifetime. And she would get about $600 per month taxable. So $600 per month in today's dollars that she has to pay tax on when she's 65. And she'd have to collect till she's about 80 years old to break even, to get out dollar for dollar, roughly what she put in. And if she passes away before she turns 65, her estate might get a $2,500 death benefit. The rest of the money is gone. If instead she put that same amount of money into a TFSA at an 8% return, she would have over $1.7 million at age 65, which she could draw out tax-free in retirement. So Jackie could withdraw like 4 or 5 times that CPP amount, so 600 times 4, $2,400, $3,000 from her TFSA tax-free, and do that until she's in her 90s and still have a nice nest egg left over that she could, like I said, pass along to anybody she chooses or any charity she chooses. So is there anybody here who wouldn't want this option, even more money, tax-free in retirement? So, wow, perfect. We're actually, this is going a lot faster today, probably. Well, I don't know. Anyway, so we've covered so much today. I'm going to just recap what we learned so far about how to stop leaving money on the table and keep more of it in your pocket. So we learned from Mark, Joe, and Tony how your business structure affects the percentage of tax that you pay and therefore your after-tax cash flow. Remember, all 3 guys earned about $60,000, but Joe, the employee, only has about $45,000 after paying his taxes. Mark, the sole prop, has about $50,000, and Tony and his incorporation has about $54,000. So go ahead and let me know in the chat if you like, whose boat would you like to be sailing in? And this is often one of the things. This is what I say is this is how the rich get richer. They take those tax savings, they reinvest it in their business. They do this over and over and over, and that's how you're able to scale your business and whatnot. So we learned about concerns around claiming medical and end-of-life related expenses from Eleni and Rob's story. And we learned from Beth and her private health services plan how providing custom benefits to employees would lower her overall costs while allowing her employees the flexibility of spending money on what they exactly needed for their family. For those of you that don't have employees and are sole proprietors or Incs, don't fret. You can still participate. There are just some additional parameters that need to be followed. So feel free to reach out to me if you've got questions about that. We also learned from Laura and Steve about how with QuickBooks, they have managed to streamline their bookkeeping. What used to take them the better part of a week each month is now taking them just over a day. So we've used all the features in QuickBooks to help them keep up to date and streamline all the functions. So the reconciliation, the bank rules, the automation. And when I talked to Laura, they just left to go overseas. So it was about 10 days ago that I talked to her. She was thrilled, like they're 3 months into their trial, and she's just thrilled that she has all this extra time now. She's like, I don't even know what to do because everything's so easy and streamlined. And so anyway, short story is that they're thrilled. And then through Lindsay's GST story, we learned that about GST registration and the importance of registering early rather than later. Plus, I shared with you that for most wellness professionals, most professionals, I guess, being GST registered can be cash flow positive, meaning more money in your pocket at the end of the day. And I shared with you about Paul and Anna and how we went back and adjusted a previous year's tax return to claim Paul's overlooked moving expenses and got him an extra $4,000. How could you not benefit from having this kind of knowledge? And then most people, of course, worry about retirement in some way, shape, or form. So through Jackie and her mom, I revealed that relying solely on the Canada Pension Plan is probably not the best retirement strategy. By becoming incorporated and saving every year the almost 12% in CPP contributions inside a TFSA with a reasonable rate of return, Jackie is on track to have well over $1.7 million in her retirement tax-free. And that TFSA money won't affect her OAS, or old age security. It won't affect guaranteed income supplement. It doesn't affect any of those income tested benefits. She could take $1 million a year out of her TFSA and it won't affect her quarterly GST or any of that. So who here desires to be worry-free to enjoy their retirement with a nest egg that they control? And who here wants to be able to pass along any of that leftover nest egg to anyone that they desire tax-free, or any charity that they desire tax-free? Go ahead and throw a comment in the chat if that happens to be you. So through all the stories that I shared with you tonight, there's hints, or today, I guess, there's hints of some of the benefits to having a tax professional on your side. I showcased with Mark and his family that having a tax professional on their side finally helped them renew their mortgage with a great rate, saving them over $73,000 in interest over the next 5 years, and helping them be mortgage-free even faster. Other things that a tax professional can help you with include the purchase versus lease analysis of a new vehicle. Whoa, I skipped a slide. Helping you understand the complexities of the EI system when you or a family member loses a job, as well as providing guidance on how to structure a severance package in the most tax-efficient manner. So most people outside of lawyers and accountants don't know that when you're let go from a job and they throw a whole bunch of money at you to get you to shut up and go away, depending on what the reason is, what the true underlying reason is, if the underlying reason has anything to do with a human rights violation or discrimination, that money that they're throwing at you, you can have it structured in a way that some of it that you don't have to pay tax on it. It would be considered damages under human rights and tax-free, like winning the lottery. So always great to reach out to an accountant whenever you're being offered money to leave a company. So wouldn't it be great to always have someone by your side helping you navigate these and other complicated financial related situations? So envision your future with less financial worries and more money in your pocket from these and other tax saving strategies that I would share with you when we work together. Your life would be less stressful and more at ease, knowing that you had a better plan to achieve your dreams and goals. Now imagine we had just completed this year's taxes, and I share with you that compared to last year, we have reduced your tax bill by a couple of $1,000s. What would you do with that money? Reinvest it to make more money? Go on that dream vacation? What if your business became incorporated? What would you do with that 12% of CPP contributions that you are no longer required to pay to CRA? Would you hire a new employee to help your business? Would you reinvest those thousands of dollars every year to grow your business even faster? Let's dream together. Take a moment and let me know in the chat what sort of options that you were dreaming of. beach vacation, a house renovation, backpacking through Europe, buying a new car. Me, personally, my happy place is Palm Springs, and I've actually got a trip booked there in 49 days, I think it is now. So I actually have written in the notes here about jumping through a million hoops to get on an airplane. So, but like I said, just booked a trip. So I will jump through whatever hoops it takes me to get there now. So anyway, have you found it worthwhile to grow your knowledge about these tax savings, these strategies that can help with tax savings? So pause now and think of yourself in 6 months. Have you taken any steps to implement any of these tax saving strategies? I know many of you are searching for more opportunities to save even more money on your taxes, especially if you own a small business. But in the past, something has stopped you from taking this step. At this moment, you actually haven't saved any money on your taxes just yet. Maybe in the past you thought the upfront costs were too high, but what if the benefits outweighed the costs? Remember Paul? He got back 10 times his investment that first year working with me. Just imagine if each and every year going forward you could save $2 or $3 or $5 or $10,000 in taxes. What would you do with that money? So in our short time together today, this morning, and it's this afternoon now, I've only scratched the surface of the many tax saving possibilities available. And I promise by the end of our time together today, you and your small business would be ready to implement some, if not all of these tax saving strategies that I've shared. So what I'm offering you is the Masterclass 2020 tax consultation, which includes a one-on-one private Zoom consultation with me, where we will discuss your unique situation, and I will provide guidance for your specific questions and concerns. So this type of consultation normally costs $250, and new clients always leave with a better understanding of how to reduce their tax bill. The last couple of times that I've actually asked this kind of question at the end of the thing, you know, have we covered everything that you wanted to cover? And people are like, you've told me way more than I ever thought you were going to tell me in this call. So the process for the offer is, Allison just put the link in the chat. You purchase your offer by going to www.aia-tax.ca/offers. And the site's also, the link is also on the slide there in the yellow box. Shortly after you make your purchase, you will receive a DocuSign intake form, which includes a CRA consent form, so that I can review and verify all the relevant tax information that CRA has on file for you. And then after completing that DocuSign, you will get an email requesting that you upload to our secure and encrypted portal your full prior year tax return. So all the pages, 20, 30, 40 pages, not just the summary and not your notice of assessment. And if you desire, you can upload any current year documents so that we can discuss them specifically during your private consultation. And then after you complete your upload, you will receive a final email with the link to my schedule to choose a time for your private consultation that works for you. So instead of $250 during this masterclass today, I'm offering this call to you for $149. For those of you that are interested, you need to sign up by midnight tomorrow night in order to get this deal. So that's sign up by midnight on March 19th to get the deal. So this offer is for you if you're interested in learning how to keep more of your money and live the life and retirement that you dream of. This is not for you if you think the government is going to take care of you in your retirement. And this is not for you if you want to learn all the legal ways to save money on your taxes. So I got a couple of bonuses for you just after I take a drink of water. So the first bonus, the special bonus for those of you that take action right now, is that I will use your prior year's tax returns and complete a financial analysis about whether or not incorporation is something that you should consider. And please know that if financially it is not something that you should consider, like it doesn't make sense, your tax savings, or there is no tax savings or very little tax savings, I will absolutely let you know. So that is often a situation that comes up with like single parents. Because they get to earn twice as much money before they start paying taxes, it oftentimes doesn't make sense for them to incorporate until a much later point in their business career. And all of my clients who complete all of the requirements for their tax return to be e-filed by midnight on March 31st gets their name entered into a draw for an Apple iWatch. So that draw is going to take place on May 24th via Facebook Live. So who's ready right now to sign up for this amazing offer? So like I said, Allison has posted the link in the chat and it's here on the screen in the yellow box or bubble at the bottom, as well as on the iPad. So it's www.aia-tax.ca/offers. And considering I don't know how many minutes late we were starting, but we're right on time. We've got time for questions if Megan has any questions.
No, that was really great. You guys, thanks so much, Christine. It was so good. I can say I've had that call with you. I hopped on this. I just wanted to refresh and not bug you again because I forget so much stuff.
No.
But honestly, your call that we had with you, it was myself and my business partner. We absolutely said that we didn't think that you would give us as much information on our personal situation that you did. So I think anyone's lucky to sit down with you and move forward with you.
Oh, awesome. Thanks, Megan.
So not a question, more of a statement.
Awesome. I appreciate it. All right. So just before we leave each other this afternoon, I guess a bit more specifically for those of you who might be watching on Facebook, I'm not sure what's happening back there on Facebook, but I want to inspire you to take action. You're only one decision away from a totally different life. Just imagine how using any of these tax saving strategies could revolutionize your life goals, your retirement, whatnot. Like I said at the one point, it's one of those things. It's how the rich get richer, right? They just reinvest their tax savings over and over and over and over, and the rich get richer. And I want to share some of that knowledge with, everyday people who, don't work in this world. All right, perfect. Well, we will end it there. I'm going to figure out how to stop streaming it on Facebook.